Okay, we're 1 minute after. I'm going to go ahead and start my clock so I keep you running on time. My name is Josh Horn, and I appreciate you being here today, taking time out of your busy schedule to do this. This is settling business valuation disputes. This is something that's kind of found me over the years in my practice. I haven't necessarily sought it out, but I've done a number of these where I've been able to help attorneys and their clients get these across the finish line without going to court, which for some people is really appealing. I do want to point out right off the bat that I am not an attorney and I'm not going to give you any legal advice today. If you have an issue where you're trying to negotiate on the value of a business in a dispute, my advice is to consult with a good attorney about this and proceed from there. Typically, I'm working with the attorney, and the other person has hired a financial expert on the other side, and they may have an attorney. Sometimes, though, however, I have had a couple of instances where I've helped the business owners and they've gone off and kind of done their own thing. However, even in that instance, most of the time they're going to get some kind of a contract ironed out using an attorney. So just wanted to make that clear right out of the gate. The other thing I wanted to mention is the focus today is going to be on operating companies, meaning construction companies, dental practices, manufacturing companies, companies that make things or sell things. They're in the goods and services, as opposed to real estate and asset holding companies, which are kind of a different animal. And maybe I'll do another webinar on those later. But this is what we're talking about today: is operating companies. So just a touch about me. My practice is around disputes like this today, estates, and M&A, which for those that don't know the lingo, that's a person wants to buy a business, a private company, they want to sell that business. That's all M&A means. I've been a CPA since 99, a CVA since 2008, a couple of NACVA awards, and I have testified in court. However, today the focus is on keeping you out of court generally, unless it can't be avoided. I put in sweating bullets into the search box to get a picture, and I got this picture from Airplane. It kind of dates me a little bit. I remember this when I was a kid. I don't know if anybody remembers this movie. So your challenge today is you would prefer a settlement in a dispute over the value of a business. You want to support that number, negotiate without guessing about that figure. You want to keep your private issues out of court if you can. Your time is limited, and whose isn't? Everybody has a limited amount of time. You would like to use fixed fees for an expert if you can. I'm going to explain the best way to go about that if you want a financial expert such as myself. Primarily, what we're talking about today are divorces and shareholder disputes. For whatever reason, I've done a lot more work in the second than the first. I've done a lot of shareholder dispute work. I don't know why. It's just kind of found me. Divorce is another area where there could be dispute over the value of a business. And as it happens, I just helped settle a case where the in-spouse had about a dozen different interests in real estate holding company. So it was quite a complex engagement, and I was really happy to be able to help them get that through. And they did not want to go to court on that valuation and spend more money on fees and that kind of thing. So that's something I did near Christmas before the end of the year. Can it be done? And if it couldn't, I wouldn't have you here, right? It can be done. Yes, it can be done. Here's the agenda. First question I want you to ask right out of the gate is, can you settle? Watch this shortcut, and I'm going to show you this shortcut I run into a lot that people try to use. 3 things and only 3 things drive value. That's it. Now, underneath those 3 things, there's a lot of things that move those 3 things, but that's what you want to focus on. I'm going to talk about that. Documents needed. That's primarily what I would advise you to gather. Push or walk. It says a little bit like Jeopardy, a little bit cryptic, but you can probably figure out what that means. Trade-offs and settlement. Your reporting options. These are reporting options that are under my professional standards that I would suggest you use. Fixed fees for an expert. And let's bring it all together. All right. Can you settle? This is the fork in the road. That's why I picked this picture. And the primary thing I want to bring up with this part is don't be confrontational necessarily, but also don't look at the world through rose-colored glasses. One of the first questions I typically ask the business owner or the attorney that's calling me about these disputes is, can you settle? And that answer varies, but that's going to determine a lot about how you proceed in a dispute. But I just want to make that clear up front that I don't want you to get overconfident about settling. I'm going to show you some things to look at to prevent that from happening, hopefully. Great book, by the way. If you don't have this book, I really recommend you pick it up. I've got my hard copy here. I use Kindle a lot, but that one, because I like to doodle in the margin, I have that one in hard copy. Never Split the Difference. Chris Voss was an FBI hostage negotiator. And there's a lot in the book. It is actually a quick read, and I've read it a few times. One of the best things I like about this book is it teaches you how to ask questions to elicit responses without offending the other side and keeping that negotiation moving. So I would pick that up if you've never read it. These are some of the tells I would encourage you to check on. If it's going to be an option, is settlement going to be an option? Will the other party take your calls? Will they meet with you? Will they provide documents? They're focused on a solution. All that said, I encourage you to prepare for worst case scenarios. You do not want to be in a situation where particularly the other side is getting ready for testimony and a full-blown report, which I'm going to get into later, and you're waiting back and expecting settlement. That's the thing I wanted to make sure that you thought about early on. If it's looking like you can't get documents, the other side won't negotiate, hiring an expert on the other side of you isn't necessarily a bad thing. However, if it looks like there is an aggressive tactic towards moving towards the courtroom, you don't want to be caught flat-footed on that. So I just wanted to get that out of the way early on so that you understand that you don't want to be in that situation where you're unprepared. You want to prepare if it looks like you need to prepare it. And what I've always used as a CPA going back to my early days is I always say, what's the worst that could happen here? And if you use that in situations like this, I think you'll be better served. The takeaway for the attorney and the owner is really prepare for court now. Just have a backup plan, worst case scenario. And so a conclusion report, which I'm going to get into later, this is a term under my professional standards, is something that's going to be a lot more involved and it's going to take more time. You have to have time to be able to do that. In some cases, at least a month in some cases, depending on the workload of the expert you're using. And then that person needs time to prepare their testimony. You may have other people involved in the case that need to prepare testimony. So at the risk of just saying it way too much, just be prepared. All right. I'm going to teach you as much as I can about business valuation for the non-business valuation people. For the technical people on here, this is probably going to be a bore, but what I've tried to do is simplify just some basic concepts down so that when you go into a dispute, if you're in one, you'll know better how to negotiate, what to look at. Watch this shortcut. I get this one a lot and pick on some of the business owners and some of the attorneys out there. I've seen this so many times. It's in the understanding of people. It's something they believe to be the case. And that's that if they take the assets less the liabilities of the company, that's the value of the business. And that is often the floor value of the business. That may work, but if it is a profitable business, usually it does not work. That's usually going to undervalue the business because it's not going to include the goodwill and intangible value of the company. I think that a lot of people go to this because it's really easy to understand. We'll take the equipment and the machines and that kind of stuff and subtract the liabilities, and that's the value. Again, if it's profitable, somebody's likely going to take a haircut if that's what's getting used. And so I really want to caution you against using that. I'll get into my recommended procedure for how you use all three approaches later a little bit, and why I think that's the best way to do this, even in a settlement situation. So this will be a trap if you have a profitable business. Again, this is a shortcut that will get you into trouble. One thing I thought of as I was putting this together, and I'm going to delve into this a little bit later too, but I just want to bring it in here just for a moment. Accounting procedures are largely that the assets and the liabilities are on the financial statements at cost. So if you take a tax return, a reviewed or even an audited financial statement, and you use equity, you're using those assets at cost. You're not using them at fair market value. So even if you were to try to implement this, you would still need to get the values of the assets appraised. Okay, what is cash flow? I wanted to explain this one because it may not be immediately obvious. I'm going to use this term a little bit today. If it's easier for you to just to think of it as profit, that's fine. It's a little less than profit because it includes in the impact of the balance sheet, which is typically the two things that move that number from profit down to cash flow are working capital needs and then debt principal payments. Those are the two big ones that move it down. So it is normally the numerator in the income approach for business valuation. And so I'm going to be using cash flow in lieu of profit today. But if it helps you to think of it that way, that's fine. Another thing to understand, and this makes some attorneys a little bit nervous, we want the forward-looking, the future-looking cash flow for the business. When we look at the business, we want to ask the question, where is it going? The past is a guide, but it may be going somewhere else from where it has been. All right. This is one of the big three in business valuation. The other two, you will understand intuitively: growth and risk. I'm not going to spend time talking about those two because most people understand what growth and risk are. Pretty easy to understand, but I wanted to spend a few moments on this one because it may not be as intuitive to the non-valuation people out there. Three things drive value. And why do I bring this up? Because if you're in a dispute or you're consulting with somebody on one, you need to understand the three levers that move the value of a business. If you're looking at a financial statement, if you look at it through the lens of these three things, it'll help you better understand and cut through some of the stuff that's not really that important. They are cash flow, growth, and risk. If any one of these happens, the cash flow goes up, the growth goes up, risk goes down, the value of the business will go up, and vice versa. Okay, so you flip those the other way, cash flow down, growth down, risk up, value goes down. Pretty easy to understand. I'm going to give you all the slides today. If it didn't immediately land, it's okay. But I think most people go, okay, I get it. That's how it works. Now let's go through a simple exercise using the big three. And I've simplified this down. I'm using a end of period capitalization model. And oftentimes I would use a mid period convention. I've simplified this and said the cash flow is all going to be received at the end of the year just to make it simple to understand. And so, valuation people, if there are any, don't beat me up on this. I've just tried to make this easy so that you can see how it works. Dust off the old algebra book. Just kidding. But it is the same thing. We're going to solve for value V using this mathematical formula. And that is V equals cash flow times 1 plus growth divided by risk minus growth. So V is value, CF is cash flow, G is growth, R is risk. All right. Now let's just pause there just a minute. We will estimate, hopefully with somebody like myself, they will estimate the cash flow, the growth, and the risk. And then they'll solve for V. Now this is the income approach. I'm not going to go through every type of approach and method to valuation, but I think this is the one that is going to help you understand when you're in the midst of this and you're trying to negotiate. This is going to make, I think, give you the most amount of bang for your buck and being able to talk to the other side, talk to your attorney, understand these issues. Now we're going to solve for V. If the cash flow of the business is $500,000, the growth is 3%, the risk is 20%. And just using the formula, the $500,000 will simplify to $515,000 divided by a capitalization rate of 17%. And that will give you an estimated value for this company of $3 million. What happens when we crank up the cash flow and growth and push down the risk? As I talked about earlier, the value is going to go up. It went up from 3 million up to 4 million. Again, same formula, just different numbers plugging in. And then finally, we're going to go with one where we drop the cash flow from the first example, drop the growth, raise the risk, and we come up with a $2 million value. A couple of things, one of which is probably pretty obvious, but I'm going to point it out nonetheless, is notice the range, very broad. I mean, in just moving those levers, we've gone from 2 million to 4 million on the high and low with 3 million in the middle. All right. The other thing is that each of those three variables, if you're moving all the levers, it's going to move the ranges for a settlement and the value that you're going to propose potentially or respond to from the other side. Ideally, what you want to do is that you want to take something that's coming from the party on the other side, or when you're proposing your number, you're saying, I think cash flow is this because of this, and document and back that up. I think growth is this because of this, and back it up, risk, etc. And a good way often of looking at it is looking at where the business has been. And if you're trying to make a claim, which may be reasonable, that the business is going to change substantially from that past, you need to be able to tell the story of why. And I can help you with that as well. You don't want to basically guess on that value if you can't back up these three variables that solidify the number. So let's dig in a little bit here. The assumption from here on, just so everybody is clear, is that you plan on working with someone like myself so that your number can survive pressure. And so I'm going to use a limited amount, but some of my professional guidance that, I was on the standards board, and our standards across the valuation community are pretty well aligned within the different standard setting bodies. But in any event, what I want to make sure everyone understands is that you can go alone, but it is more challenging. And if you do want to do that, I have provided you with some information on how to at least gather the data. Okay, I did my very best with this to get this on one page. And I tried to take the approach that if you had held a gun to my head and said, I want this on one slide, what would you absolutely positively put on that one slide? And so that's what I did here. And I am going to spend a few moments talking about why I need these, because you may look at some of them and go, why in the world would you need that? The valuation date. That is something that I'm going to look to the attorney for guidance on. And ideally, what we want is a situation where the attorney for both parties is they're on the same page with that valuation date. Otherwise, it gets really difficult to reconcile settlement reports and numbers and those kinds of things. And there's a few reasons why the business might be materially different after a date or before a date. What drives it? Part of the reason why I'm looking to the attorney is because it may be determined by statute or court case or something like that. In a divorce situation in Illinois, it might be the date of the filing. In a dispute between two shareholders, it may be agreed that the valuation date will be the date that one of them left and stopped working at the company, possibly. It could be a number of different dates, and that's why I do not guess on this. And even when I'm just working directly with the business owner, I'm thinking of an instance a few years back, I still got that information from him. And in that case, he and his partner owned three companies, and they ultimately decided they wanted to part ways, and he would own one and the other gentleman would own the other two. So that was an interesting assignment. And so I gave them reports for that. But in any event, I'm still looking to the client or the attorney on that valuation date. The percentage to be valued, again, very important. And I get that from the attorney and or client. This is particularly important if we're talking about a deadlocked, that is a 50% interest or less. And discounts for lack of control and lack of marketability can come into play depending on the jurisdiction and court cases and those kinds of things. So that's something to understand. The way I explain it, and I've got some videos out on YouTube if you want to take a look at them. I know one in particular talks about this, and that's that in a deadlocked or less percentage of ownership situation, the sum of the parts may not equal the whole because of the discounts. And the reason why is because in some instances, because if I have full control of the company and I can sell it relatively soon, there's value to that. Whereas if I'm at the deadlocked or less, there's less value there potentially. Now, in some jurisdictions, they don't allow discounts, but it's important to understand how much do you own and what percentage are we valuing. NAICS code. I'm going to drill in on this a little bit because a lot of tax returns, not picking on tax preparers. I was a tax preparer for 15 years, an advisor. A lot of these codes are wrong. I'm going to repeat that again. A lot of them are wrong. When I ask the client, the business owner, what do you do? And then I pull that code that's on that tax return and it doesn't match up to the Census Bureau site as to what they do. There's a couple of reasons for that. One is just sometimes the person that prepared the tax return is just trying to clear a diagnostic and move on. The other reason is that common reason in this environment is post-COVID. Some of these companies don't do the same thing they did before COVID. So in order to survive, they may have changed their business model. And in some instances, the code has changed over time. So I push in hard on this because this is where I get my comparative market data, my industry reports, my financial analysis. It's driven by this code, so it needs to be right. I would not guess on the code. I spend a fair amount of time when it's not obvious in particular. I mean, if it's something pretty obvious, like in some cases, an electrician, it may be pretty obvious, or a plumber, but there are some niche businesses, particularly one of the ones that can be tricky is manufacturing, and some of them distribution, where they build certain things and not others. You really need to drill down into that Census Bureau site and make sure you understand exactly what the company is doing. And you may not have thought about it too deeply before, even if you're a business owner. I mean, you're trying to make profit and payroll and that kind of thing, but it's important to understand because it's going to guide a lot of the data for analysis and what similar companies sell for, et cetera. 6 years of income tax returns and financial statements, ideally on the accrual basis. This is a little bit personal preference because I like to get 5 balance sheet measurement periods. Sometimes I don't need all that, but this is what I typically ask for in the front end. That is going to typically capture a full operating cycle of a company, particularly if that type of company is a little cyclical in nature. Maybe they have high highs and low lows as the economy changes. There are companies like that, particularly companies that rely heavily on the overall economy, interest rates, and demand, and those kinds of things. So that gives us a period to look back and say, okay, what has it done? And then ask the questions about where it's going. Depreciation schedule, particularly if we're talking about companies that are capital intensive in nature, they're buying heavy equipment and manufacturing. They may be buying presses and sophisticated machinery. These machines can cost millions of dollars. Or in the case of trucks, I mean, it still could be $50,000, $60,000, $70,000. So it has a material impact on the cash flow of the business. And I like to see historically on what's on that depreciation schedule, what are they spending on capital expenditures, so that we can estimate what's going to happen going forward. Interim financial statements through the valuation date. What's that in non-Greek terms? Oftentimes, small businesses get their books cleaned up, heavily scrubbed once a year. It's really common. We're coming off a calendar year. We're not too far removed, although we're getting through the first quarter here, right? But let's say in many instances, the small business or medium-sized business has got their books scrubbed for their tax return at December 31st of 2025. Well, let's say fast forward a couple of months and we'll have a dispute here, and the attorneys decide they would like to have something more recent. Well, we may need to get those books scrubbed up a little bit through, say, the end of March or something. And so that could take a little time. So we want potentially a stub period for the first 3 months of 2026. The values of any appreciating assets held on the balance sheet. I alluded to this a little bit before on the shortcut slide and watching that shortcut. Usually it's not recommended by the tax advisors to put things in an operating business like real estate or investments and stuff like that, but people do it anyway. And that's why in some cases we may need appraisals for real estate that's been put into, say, a corporation or something. Sometimes they put even like investment accounts or something like that, and we'll need statements for those. So there may be separate appraisals or documents needed to support what's on the balance sheet. And that's why I do a document review early on to check for these things. Legal documents affecting the interest. Again, I'm often deferring to the attorney whether or not this is going to apply to the case. I like to have them on file so we can talk about them and discuss them. In some instances, depending on the legal jurisdiction and the precedent and that, it may be that legal document tells us exactly how this is going to be valued. And a judge may say, well, you have to follow that document. In some cases, maybe not. But I like to have that discussion with everybody up front. If there's a buy-sell agreement on file and there's a triggering event for, say, a shareholder dispute or a divorce or something like that, there may be something in the document that says this is how you have to do it, and everybody signed it. So it's important to make sure that if that document or documents, they exist, that we look at those and the attorney clears that, figures out what we need to do. Projections and budgets. I like these because they give me a window into the mindset of the owners and management as to where the business is going, where they think it's going. That may or may not be supportable, but we'll have it and it will give us an opportunity to ask questions about whether or not basically the other data points that we might gather line up to where they think it's going. I rarely get these because most small, medium-sized businesses do not prepare these. Occasionally they do. When I get them, it's often kind of basic revenue, sales projections, maybe not real detailed budgets and cash flow. But again, it's like a lot of things I ask for. I want to get that no, just so I know that I asked and it doesn't exist. So I'm going to ask for it anyway. A lot of times that one's going to be a no. We don't have it, but I still like to ask because it can give you a window into what they're thinking. Physical locations. This has a couple of impacts. They may be involved in different markets. The company may be in different markets. They may be in different states. Some of them may be growing faster than others. Typically, more locations means more employees and more complexity to the business. So I want to make sure I understand exactly how many locations they have. And then the number of employees, full-time, part-time, and owners on payroll. Often in corporations, the owners are taking a W-2 salary of some kind. And so that's going to give me a sense of the size and scope of this business and how they're constructed exactly. One thing I like to do often is also measure the revenue or sales per employee, which is a nice performance metric to measure that against similar companies in the NAICS code to see if they're better or worse than similarly sized companies. Okay, when to propose a number. This is my suggestion. I've been doing this for a while. I think this makes a lot of sense. If the cash flow is greater than zero or the assets are greater than the liabilities, that business probably has value. So again, if you're not comfortable doing this analysis yourself, hopefully you'll get somebody to help you with it. If you are, this is one suggestion I'd make to you is that, find out if the business actually has value. And this is your guidepost here for doing that. If in some instances where there's no potential for future cash flow, that is, it can't be turned profitable in likely any circumstance, that business may need to be liquidated to raise cash to settle the dispute. All right, just pause on that just a minute and think about that, because that can happen sometimes. If it can't be profitable, it may need to be liquidated to basically get any cash out of it to satisfy anything. Now, when the value could be zero, and this is one of those instances where someone might be really disappointed, but I just want to point this out. This does happen. And that's when the cash flow is unlikely and the assets are less than the liabilities. That business probably has no value. So don't assume that everything that you're involved in, either as an advisor or an owner, unfortunately, as heartbreaking as it might be, the reality is that some of these don't have value. So it's important to cross this bridge before you get too deep into certainly litigation so that you can actually, your attorney hopefully pick up the phone, say, okay, I've done an analysis and we've worked with an expert. We don't think there's any value here, and have a reasonable discussion. Hopefully the person on the other end of the phone is rational and they'll have that discussion with you. But some people are not rational. So keep that in mind. All right, let's talk about trade-offs. In settlement scenarios, you have to accept certain trade-offs. That's the reality. Not every stone is going to get overturned. Not every document is going to get looked at. That's just the reality of it. That is the trade-off for fast and potentially cheaper on fees. What does that mean? Those management interviews will be limited or not at all. In some instances, the attorneys, they may be preventing management interviews or strongly discouraging them. And again, this is one of those situations where oftentimes, I'm going to ask, and in some cases, I may be denied for whatever reason, but I'm still going to ask because in my experience doing this work, there is no greater data obtained than looking those owners in the eye and going out to that business and looking at what they're doing. In terms of time well spent, that's always been my experience. I like to do some analysis on the front end. Sometimes, though, when I go out and talk to them, it changes my impression drastically, or it just improves my knowledge level so much greater when I go out and talk to them. Now, again, in those litigation situations, those management interviews are going to be potentially limited. In settlement situations, those documents that you might want in an ideal situation will be limited. And what does that really mean? That means that future cash flow may be higher or lower than what we think it could be because we don't have all the information. Growth could be higher or lower than what we think it could be. And then risk could be higher or lower than what we know. Okay, let's go into some specific examples of trade-offs. I'm posing the question, it's a little rhetorical. Will this information be known? These are a few examples that I want to let these swirl around in your brain. The answers to these questions won't be known necessarily if the goals are speed and lower fees, because we may just not get to ask them. Let's say, for example, $1 million of sales are expected from new customers. That's going to make the cash flows go up, right? The cash flow is going to go up. Arguably, the value is going to go up. If you're an out spouse in a divorce situation, are you going to know this? Well, not without some interviews and without looking at some documents and talking to some people. So that's a potential trade-off, potentially something you leave on the table if you don't get to ask that question. What about cash flow going down because this company needs $1 million of equipment purchased to stay in business and to continue to grow? Are we going to have that information? Maybe, maybe not. Depends on how fast we want to go, how many documents we want to look at. Growth could potentially go up if the company's developed a high demand technology. It's going to push growth up potentially. Do we know that? I was hired by the group, but the operating business owner, his attorney hired me. This ended up going to arbitration. It did not settle. I wanted to bring up an example to illustrate. You may say, well, how in the world could these things not be known, Josh? Believe it or not, because in this instance, they were the owners, the other owners were the second generation. Their father had passed. They were out on the East Coast somewhere and were not near this business. They weren't involved in the day-to-day running of that business at all. And so they didn't know a lot about that. And so candidly, that gave me an extreme information advantage in that case, because I could just pick up the phone and talk to the owner. Now they could have too, but they elected really not to really go out and do a site visit and actually explore that on the other side. So I always like to ask questions, even if I get a no, because at least I know I asked. What if the company's headed into a down cycle? The growth is coming down. The owner is absent from a successful business. Now, again, this would be in one of those situations where maybe not everybody is all right there knowing what's going on. But I'm going to give you an example. Generally speaking, in most owner operator businesses, the expectation, and especially a small business scenario, is they're going to be there every day working. Well, if they can go out to the golf course or take a nap on a regular basis, just be on vacation most of the time, and this thing is still running like a top, producing all kinds of profit, well, I might, in some instances, push the risk of owning that business down because they're not so reliant on the owner. They've been able to develop processes and procedures such that the risk is lower. What about one customer is 90% of sales? That customer picks up the phone and says, yeah, we don't want to do business with you anymore. And they're effectively bankrupt the next day. That can happen. Will we have that information? Will we know that? I talked a little bit about discounts earlier. The issue here is once we get the guidance from the attorney on whether they think control and marketability discounts apply, are we going to have time to deep dive those in a settlement scenario? Are we going to be able to do that? Can you accept those trade-offs, or do you want more information? So these are some examples of trade-offs that could come into play. The best ones I could think of reflecting the big three earlier where they're going up and down. Reporting options. This is just an example of my report cover. Could be used. This is straight from my professional standards. A calculation report is what I recommend in most cases for settlement. This is where I and the client and the attorney could be the one that is conducting the engagement. We're going to agree to specific valuation approaches, methods, and the procedures we're going to do, and that results in a calculated value. The goal with this report, and it could just be a few schedules, it often is not nearly as involved as a conclusion report, which I'll get into later, the goal settlement. The basic procedures around this, I agree with my client. It is allowable within my standards to limit the scope of what's analyzed and prepared in a report. These are the typical examples that I utilize. They're an income approach using capitalization of net cash flow, which was the formula example earlier, or discounted net cash flow. That one is used most often when growth, risk, and cash flow aren't necessarily stabilized. So we're looking at projections until the business gets to a stabilized point. Much more involved, much more time consuming, but they may be necessary. I just valued a high growth business. Just candidly, I've been working for a long time. I have never seen a business growing as fast as this one was, but they were also in a situation where they're also like one phone call and they could be out of business tomorrow. So it's a wild world out there, and certainly a capitalization, which assumes everything is just kind of steady Eddie, was not going to work for that company. Market-based approach. So we're getting comparable companies from either the private broker transactions of sales of private companies or public companies for the market approach. And then the asset approach using the adjusted net assets method. I like to use all three approaches if there's enough data. And there's a couple of reasons why I like that. One of which is I think that it sort of forces everybody to be a little bit more honest about their reports. If you pick one of the three, sometimes I see, unfortunately, sometimes I see a little cherry picking. So people will pick the one that gives them either the highest value or the lowest value. If you do all three, that's harder to do. This is a term I use. You've probably heard the word before, but I use this in valuation a lot. I like to triangulate the value of the company. And what I typically see for a profitable company is the income and the market approach will be here, the asset approach will be here, and then we'll have kind of an upside down triangle with that middle part being the goodwill or intangible value. Goodwill and tangible value is quantifiable. It's not unicorns and pixie dust. We can actually quantify that amount between the asset approach, the income and market approach. Now, if we have a highly capital intensive company, we may see all three on kind of a line where they're all very similar, or we could have a flip and a right side up triangle where we've got the asset at the top, income and market at the bottom. And there is essentially is no goodwill because it's low profitability. And it's kind of like a situation where the assets less the liabilities is the value of the business. So that's why I like to use all three so that we can get our arms around the value and defend it better. Using a calculation report, we can negotiate with real numbers. We can do it in person or on Zoom or other technological options. Zoom's just one of them. I use Zoom a lot, but there's other ones out there, of course. You want to understand the trade-offs that I showed earlier. You could consider proposing a range. This is kind of an attorney strategy thing. I'm typically not lead negotiator in these situations, and they may have a different philosophy on this. Chris Voss has a philosophy on this in his book, Never Split the Difference, which I alluded to. But around the key thing I want to drive home with this on around risk management, and I always make sure that the attorneys are understanding of this. Most of them understand the rules and the jurisdiction, is that you ideally want to protect that calculation from discovery later in case the case goes to trial. Because what can happen is that if I get more information later, I may change the value in a conclusion of value situation, which I'm going to talk about that because I'm not limiting my scope. I'm going to talk to more people. I'm going to look at more documents. I may change my opinion later once those documents come to light. But all that being said, I give it to my clients straight, no matter who hires me. It's never in my best interest as an expert to basically blow smoke because ultimately I could end up testifying. I want to be completely objective and unbiased. How about a calculation for court? You might say, well, why wouldn't we do that? It is limited in scope by definition. It's less work than a conclusion of value. And actually, in our professional standards, and a smart attorney will pull these, they can fry somebody on the stand if they go into court with the calculation, because right in the standards, it says the results may have been different than a conclusion. So I don't recommend doing that. You could have that report disqualified by a judge. A low budget is not going to be an excuse. In fact, it may get you into more trouble. And so I would really encourage you to understand all the risks around this before you go into a courtroom with a calculation. I don't do that. That's not what I do in my practice. So let's get into what a conclusion looks like. I'm not going to deep dive this because I want to keep you running on time. All of these provisions in a conclusion, which is a report that is typically a narrative report, much more lengthy, typically more analysis, more interviews. These quotes are from Revenue Ruling 5960, IRS Revenue Ruling 5960, which represents the bedrock of a lot of what we do in business valuation, even outside of tax engagements. We're going to look to Revenue Ruling 5960 for these things to address in our report. In a settlement situation, we may very well not have time to deep dive each of these. But this last bullet point is the one I really want to drive home. If it looks like this thing is going to trial, to court, what a conclusion report does is it provides a detailed narrative report that does all the things in this last bullet point, and a good one will write a persuasive story supported by good data. And so the expectation here is that you couldn't negotiate, you couldn't settle the case, you're going full report, and it's going to need all these things to be able to stand up to scrutiny. Fixed fees for experts. Call me early. Best advice I can give you. One of the first questions I always ask an attorney or a business owner is their name, of course, if they haven't already provided on a voicemail or an email. What's your goal? What do you want to accomplish? And then I'm going to clear conflict of interest, hopefully, or if I have a case where I have a conflict of interest, maybe a related shareholder or something, I'm going to say, well, I can't work on that, or the other side has already called me or whatever. But if I clear conflict of interest, you want to avoid document drip drip to get fixed fees. And what's that mean? Document today, a couple more days, another document, a couple more days, another document. That takes forever. And what I like to do is be really active early in the process and get all the important documents, a lot of which were on that other slide, get them as early as possible in electronic format so that I can get going on this project as soon as possible. The drip drip is what takes the time and makes it harder to fix fee the engagement. Then we can determine, does the business have value? Then the attorney or you as a business owner can say go or no go. And then we can define the project in detail. And that makes it typically a lot easier to fix fee it. Meetings are a wild card. Do we know how many meetings we're going to have? Can we estimate that up front? Maybe we're going to have 3 meetings, an hour apiece. We're going to keep it at that. Then I can more typically be able to say, okay, I can help you and we can budget this for a fixed fee. If the meetings are like, oh, we don't know, we have no idea, maybe the way to price that engagement for me as an expert is to fix fee a report, and then the meetings are billed hourly, something like that. That's sort of a hybrid method. Organization and responsiveness are critical. Let's bring it all together. This is so important. I said it twice, right? Call me early if you want to try to settle your case. Typically, you're going to be contacting an attorney first, though. I just want to point that out. That's why my opening statement, but often you're going to be contacting the attorney, and then hopefully the attorney will contact me and we'll have a phone call or a meeting. Prepare for those worst case scenarios where you can't settle it. Watch those valuation shortcuts. Remember the big 3. Get those documents electronically and get them fast. Find out if the business has value, hopefully with my help or somebody's help, because you don't want to spend time fighting for something, incurring fees and time and that kind of thing if there's no value to the business. Understand those trade-offs that you accept in a settlement situation. Calculations are what I recommend for settlement, and conclusions for court. And my fixed fee suggestions, which were on the last slide. Thank you very much for everything. I've got at least one question I need to address out there, and I'll hang on here for a few minutes. I assume if everybody hasn't had anything to eat, they probably want to get off here and get some food. Here's my contact information. I'm going to get this recorded, edited, and I'll get this out to everybody that participated. If you have colleagues that were jammed up today and would like to look at it, I can send it to them too if you send me an email address. Well, I will let everybody go if you're good, and have a great day. My name's Josh Horn, Horn Valuation. Here's my information. Reach out if you got anything. I'll see you later. Bye-bye.